So for the past 2.5 years or so, Tesla has been the most bet against market in the stock, largely because, well, there are some skeptics against the company's business model, there's no question about that. But it's been one of the most actively traded and also actively traded in the options market, so that engenders a lot of activity in short selling. It's not always lucrative, although this year it certainly has been. Apple has overtaken Tesla as the most shorted stock in the market as of this week. There's about $16.3 billion in bets against Apple compared to about $16.1 billion in bets against Tesla. Now, you could argue that this is skepticism against Apple's business model going forward, and we talked about this a couple of times this week, JD, with respect to the underwhelming response that we saw in the product launch earlier this week and the fact that Apple is going to struggle at the high price point when investors are pulling back on discretionary spending. But what I think is representative of is the fact that Apple is a good way to play the market short rather than the stock. In other words, Apple sits in the most important indices in the United States, and it makes up the most significant weight in the S&P 500. If you put Tesla and Apple together, they're about 9% of the entire market cap of the S&P. So shorting those stocks is a proxy for shorting the market. And if the anticipation is that the Fed has that soft landing, which they tame inflation but keep growth going, that short probably won't materialize into profitability. But if the Fed doesn't engineer that and we end up with a recession in the first quarter of 2023, the market is going to react accordingly and those shorts will pay off. So I think to some degree it's more of a representation of that than it is the metrics of either company, although you could argue to and fro for both of those over a number of weeks. Shares of Tesla have shot up by nearly 15,000% over the past decade as the disruptive company established itself as the leading player in the electric vehicle space. That remarkable upward run has brought Tesla's market capitalization to $930 billion as of this writing, making it the sixth largest public company in the world. Apple, meanwhile, is the world's largest company with a market cap of nearly $2.7 trillion. Tesla has a long way to go if it's going to catch up to the iPhone maker. Could the electric vehicle leader manage it by 2030? Starting from a far smaller base, Tesla's market cap has increased at a much faster pace than Apple's over the past decade. The eye-popping growth of Elon Musk's company isn't too surprising as it operates in a market that is still taking off. Apple, on the other hand, reaps nearly half of its revenue from selling smartphones, the market for which has already matured. For instance, in 2021, sales of electric vehicles doubled year-over-year to a record 6.6 million units, according to the International Energy Agency. The impressive growth has continued in 2022, when 2 million electric vehicles were sold in the first quarter alone, a 75% jump over the prior year period. On the other hand, according to research firm Gartner, smartphone sales increased by 6% in 2021. On the one hand, that small increase brought unit sales to 1.43 billion devices. On the other, the industry has run into trouble in 2022, with sales down 9% year-over-year in the second quarter due to a combination of oversupply and inflation. The respective health of the electric vehicles and the smartphone markets is naturally reflected in Tesla's and Apple's latest results. Tesla's total revenue shot up 43% year-over-year to $16.9 billion in the second quarter. Adjusted earnings jumped 57% year-over-year to $2.27 per share, driven by fatter margins. Tesla's non-GAAP operating margin was up 358 basis points over the year-ago quarter to 14.6% thanks to an increase in the average selling price of its vehicles. Apple's growth was nowhere near that rapid, but that's not surprising given its massive scale. For its fiscal 2022 third quarter, which ended June 25, Apple's revenue increased 2% year-over-year to $83 billion. That was nearly 5 times Tesla's revenue. With a sales base that huge, even a multi-billion-dollar top-line gain would translate into a small increase in percentage terms. But at the same time, it is also worth noting that the pace of growth in Tesla's end market is far greater than is occurring in Apple's end markets. That's where Tesla's advantage lies. Sales of electric vehicles are expected to grow at a rapid pace through 2030. AlixPartners estimates that a third of all vehicles sold by 2028 will be electric vehicles, with the proportion increasing to 54% by 2035. That would be a big jump over the first quarter of 2022, when electric vehicles accounted for 10% of global vehicle sales. With overall vehicle sales expected to jump to 122.8 million units in 2030 from 85.3 million units in 2020, Tesla's addressable market is set to increase rapidly. Meanwhile, the global smartphone market is expected to clock 7.6% annualized growth through 2030. That pales in comparison to the 29% annualized growth expected in electric vehicles sales through the end of the decade. Tesla, therefore, is in a solid position to grow its revenue and earnings at a faster pace than Apple through 2030. Not surprisingly, analysts expect Tesla's earnings to grow at an average of 45% annually over the next 5 years, a pace that it could sustain beyond that given the market opportunity ahead of it. Apple is expected to clock annual earnings growth of 9.5% over the next 5 years. This explains why the Future Fund, an Australian wealth fund, anticipates that Tesla's market capitalization will hit $4 trillion in 2030. All this indicates that Tesla could keep growing its market capitalization at a faster pace than Apple over the next 8 years as it has done in the past, and that could make this electric vehicle play more valuable than the iPhone maker by 2030. Given its $2.8 trillion market capitalization, it may be difficult for some investors to wrap their heads around the idea that Apple stock may be a good buy these days. But investors may change their minds after they take a closer look at the company's underlying cash flow relative to this valuation, as well as Apple's growth opportunities. While investors will want to do their own due diligence before they buy shares, here are 3 bullish points about the company to help you get started. Apple's free cash flow, which is the cold, hard cash left over after all regular business operations and capital expenditures are taken care of, came in at about $108 billion over the trailing 12 months. This means the stock trades at 28 times free cash flow, a reasonable if not attractive valuation for a company with a diverse set of products, a loyal customer base, and a long history of disciplined and value-creating capital allocation decisions from management. Apple's substantial cash flow gives it lots of optionality as to how it goes about creating shareholder value. While some of its cash from operations is reinvested back into the business via capital expenditures, the leftover free cash flow allows the iPhone maker to either pay back dividends, repurchase shares, or do both. Apple, of course, has done both for years. It spent $91 billion repurchasing stock over the last trailing 12 months and it paid out $15 billion in dividends over that same period. Despite Apple's aggressive capital return program for shareholders, the company still has $179 billion in cash and marketable securities. Further, even when you subtract the company's debt from its cash, it still has a net cash position of $60 billion. Apple's strong revenue performance during a time of global macroeconomic uncertainty is also impressive. That's it for today. I hope you enjoyed. I would appreciate it if you could subscribe and like the video as it will help out the channel a lot. Make sure you do not forget to turn on notifications by pressing the bell icon so you do not miss the latest news surrounding Apple stocks.